Hey all, welcome to ShareTreck. This is Raj here, friends. It's very difficult to get back onto the swing of things. I just came back from the vacation and I think I'm coming down with a cold or something like that. I was extremely careful, but there's a plane full of screaming children who are also coughing and whatnot. So I think I have got a bit of a bug and I'll have to ride over it. But I thought that I might as well start doing the videos right now, so please pardon my voice if it's a bit hoarse. But I think I have a lot to say about the markets, and that's why I'm doing this video. You might find it very interesting because it's a continuation of a video I did earlier before I went on vacation, where I identified a bunch of companies which would likely do very well in the new Trump presidency. Now I'm going to zoom out a little bit more and give you more perspective the way I look at it. Of course, not financial advice, just my personal opinion. And I'd like to hear from you guys what you think. So that said, let's get started. So as the markets brace for President-elect Donald Trump's return to White House, the anticipation of his policy agenda is already driving significant shifts across sectors. Investors, policymakers, and businesses alike are grappling with the potential implication of his tax, trade, and spending policies. And you'll say, Raj, he has not yet taken over as president, and how do you know about his policies and all that? Well, it's already been published a lot in the media from Trump himself and his surrogates. So there is a very clear understanding of at least the big blocks or pillars of his policy. So we know about his tax, trade, and spending plans. And these policies aim to boost economic growth and assert US dominance globally. They also carry risk of economic instability and sectoral upheaval, because the economy is not a monolith. It's composed of moving parts. There are many components that go together to make the economy. You change something in one place, it pushes something up somewhere else and something else down somewhere else. So they're all interconnected. So we have to keep that in mind, and that's going to be the reason why we'll have to be picking up sectors and stocks very carefully in the new presidency. Let us start off with Trump's proposed tax cut promise. Immediate financial high-income earners and corporations will benefit from that. However, it will be without corresponding spending reductions, and this policy risks significantly increasing the federal deficit. Though Trump has indicated that he would have Elon Musk and Vivek Ramaswamy to be heading a new department called as DOGE. So that department is supposed to reduce the costs and wastage across the government sector. And Elon Musk elsewhere in his interview had indicated that he would slash $2 trillion from government spending. And I think such cuts could lead to mass layoffs, because the way a private company works and the way a government works are two different things. But just imagine $2 trillion cut in the government spending, which means entire departments are going to be gutted out. Lots of people are going to lose their jobs. And this is going to exacerbate the unemployment and create ripple effects across the economy. Now, what could happen is that, on the other hand, they're going to deport a lot of people. So there will be a shortage of people in the economy. And maybe the people who came out of government will find job in the non-government sector. But most of the people who are being deported are working on low-wage jobs, like maybe fruit picking or taking orders in a drive-through or something like that. And I don't think laid off government workers are going to like to do those kind of jobs. The tax cut would, in my opinion, disproportionately benefit the top earners, who are more likely to save than spend. And this dynamic could make the luxury market much more dominant, but the consumer discretionary goods are going to kind of fizzle out a little bit, and a trend that investors in retail and consumer-focused stocks should watch closely. You would have seen the news about Amazon. Amazon stock prices fell sharply recently, so that's part of the reaction out there. The anticipated tariff policies pose another challenge. Tariffs are likely to increase the cost of imported goods, and indirectly, domestic produced items reliant on imported raw materials will also go up. This would drive a form of policy-driven inflation, making goods more expensive across the board. Recent remarks from Federal Reserve Chair Jerome Powell underscore the central bank's cautious approach. Powell emphasized that while inflation is moderating, the Fed is not in a hurry to cut interest rates further, signaling that borrowing costs will remain elevated for the foreseeable future. And now, this is what I think is going to happen. When Trump goes through with the tax cuts and the tariffs, it's going to create a lot of inflationary pressure. And during the inflationary pressure, which is policy induced, the Fed may decide not to intervene because it's a policy-driven issue, and raising the interest rates may not be the solution to it. And in which case, we may see some kind of confrontation between Trump and the Federal Reserve. Trump has in the past said that he wants control over interest rates also. So if he does that, remember, US dollar is a reserve currency, and bond vigilantes may decide to act. So regardless of whatever interest rates Trump might set up, the bond vigilantes will decide what price they are going to buy the bond for. For example, if you have a 2.5% yield in 1 year, then the 1 year bond will be sold for $97.5, and at the end of 1 year you will get $100 from the government. But the bond vigilantes may not buy it for 97.5. They would buy it for much lesser, thereby increasing the yield. And that's what causes problems for, in the past, if you recollect the Greek bond crisis when the EU decided to backstep them, something like that might happen. But we have never seen that happen with the US dollar. So the question is, in the emerging markets, there are not enough governances, and therefore lack of governance and predictability creates bad conditions for bonds, and the yields go up. Is US going to transform into an emerging market type of dynamic? If so, then the bonds are going to play havoc. So when the yields go up, the bond price is lower, and therefore most people would prefer to put money in the bonds because they can buy a $100 bond for much lesser and be assured of getting their principal plus interest. Whereas in the stock market, with all the tariffs and other things going on, a lot of moving parts, the risks are much higher. And therefore, these dynamics will start influencing the market. I think they are already influencing bond markets where yields are climbing as investors adjust to expectation of slower rate cuts. This environment could weaken the balance sheets of regional banks. You will recollect that a few regional banks had folded up when the yields went high and their bond face value went down, the bond market price went down, and weakening their balance sheet. So I would personally say that I would avoid regional bank stocks because they are especially vulnerable to declining bond yields. The Trump administration's policy direction suggests divergent fortunes across industries. Let us talk about each of these industries briefly. Despite higher interest rates traditionally being a headwind for tech companies, the AI buzz has provided resilience. Companies like the Magnificent Six, like Amazon, Apple, Google, etc., and companies like Palantir and Nvidia may weather this period well due to their indispensable technologies and pricing power. However, revenue growth might slow, particularly as global competitors face challenges entering US-dominated markets. Trump's nomination of fossil fuel-friendly Doug Burgum as the Interior Secretary, coupled with reduced emphasis on renewable incentives, signals a shift towards fossil fuels. Environmental progress will likely stagnate, and insurance companies may struggle to balance increasing risks from climate disaster with the pursuit of profitability because there will be more and more claims. Climate-driven migration could also spark geopolitical tensions and domestic backlash. The nomination of RFK Jr. as Health and Human Services Secretary introduces uncertainty for the biotech sector. Given his controversial stance on vaccines, investors should take this sector with caution until policy directions become clearer, which means you have to be careful with your biotech investments. Trump's plan to eliminate the 7,500 EV tax credit will reshape the electric vehicle market, while Tesla supports the move, likely to hinder competitors like GM and Rivian. The broader EV sector may face challenges in maintaining growth as subsidies are withdrawn. And if Tesla becomes the dominant auto company, Tesla shareholders are going to benefit because Tesla can have pricing power because there will be no other competition for EV. On the global stage, Trump's presidency may empower allied nations to resolve long-standing territorial disputes with reduced US intervention through institutions like UN or NATO. For example, Russia, Israel, and India stand out to be potential beneficiaries of this shift in geopolitical strategy. For investors, the current landscape calls for caution, but also presents opportunities. Avoid regional banks due to their exposure to bond volatility. Focus on companies with pricing power such as leading tech firms and luxury brands, as these are better positioned to navigate inflationary pressures. Consider US dollar denominated assets which may gain appeal amid a stronger dollar. Monitor industries affected by policy shifts including biotech, energy and EVs to identify potential entry points or risks. As we enter a period of marked significant policy-driven changes, the market's reaction highlights the need for strategic positioning. Investors should remain vigilant, balancing short-term risks with long-term opportunities in a rapidly evolving landscape. I think there is much more complexity to be unraveled. I am thinking about what is going to be the effect of the tariffs. On first glance, you can say that tariffs are going to cause inflation, but with the US dollar becoming stronger due to the tariffs, I think that there will be a little bit of compensation out there. I have to flush that out. Reducing taxes by 2 trillion by giving another huge tax cut is going to increase the government deficit. Part of that deficit will be fulfilled by money coming in from tariffs, but at the same time, they will have to cut costs. If they do not cut costs, the $2 trillion deficit would mean income taxes will have to go up. And if they raise the income taxes, then people are going to be unhappy because the top earning people would have got 2 trillion tax cut. You can't do both at the same time. So there will be a platitude of a little tax cut for the lower income group and the middle income group, whereas the bulk of the tax cut, like in the past, might go as permanent cuts for the top 1 to 2% or 1 to 10% people. And most of the people who invest in stock market belong to the top 10 to 12% region, and the others are indirectly involved in it through their pensions. Now, with increasing deficit, the government may want to cut costs in terms of reducing social security entitlements and other benefits like Medicare and other things. So it's looking very complicated. So I don't know how things are going to pan out beyond what I have spoken so far, but all of that can be forgotten totally if all the policy decisions, when they manifest maybe 6 months to a year down the Trump administration, if the overall economic community or the financial community starts feeling that the US is more unpredictable and looks more like an emerging economy, and institutions which were giving stability have been dismantled or diluted, then the US dollar as a reserve currency is going to take a big hit. So I would expect that at that stage, gold prices may go up. Gold, platinum, those are the assets, and I look at Bitcoin also as assets, which might probably go up. And in that situation, for people to have US dollar denominated assets is going to be a big problem. And if the US dollar becomes weak, then countries like Saudi Arabia, which are pricing oil on US dollars, may decide to accept other currencies for pricing so that they can preserve value. So those kind of possibilities are there. I'm not saying it's going to happen, but with the BRICS and other things, other formations taking place, that could be a possibility. Also, I'm thinking that during the 4 years of Trump, UN and NATO are going to be becoming more and more irrelevant, and we are going to have much of a multipolar world where every country is transactional. They may ally with somebody for something and be against the same person for something else. All those kind of things are likely to happen. and the peace that we have enjoyed for a long time, which has underpinned opportunities to invest manpower, capital, and intellectual abilities on science and technology, is going to be diverted towards more of defensive and offensive capabilities. So we are looking at a lot of changes happening, and the island of positivity I see is the Mag 6, Palantir, Nvidia. Those are the companies that I think are going to give positive returns. Of course, there are companies which give staples like food, clothing, and shelter. You look at Walmart, you look at Costco. Those companies will still do very well because they are going to provide the basic necessities which people cannot go without. Their margins may not suffer. We have seen that during COVID, the margins stayed well. In fact, margins got boosted. But inflation is going to come back with a vengeance, which means housing sector, renovation, all those things are also going to suffer. Not only in US, but it will also be an impact in Canada, because fixed interest rates for mortgage in Canada depends on the bond yields in the US. So I suspect that more of the housing financing in Canada will go on into the variable rate, which depends on the Canadian bonds. We'll see what happens. So my friends, that was my take on all that I was able to think through on my flight back from Cancun to home, and I put it all together. And I look forward to your feedback. What do you think? What are your thoughts? What industries do you think are going to do well? Unfortunately, I don't see a positive environment for biotech, and which includes genomics, of course. So please let me know what you think. I look forward to your comments. Thanks and have a great day. Bye for now.